Hi. My name is Mark with High Vibe Financial, and thank you so much for joining me today. Today, I'm just going to give you guys a little bit of a background and teach you about the foundations of the infinite banking concept. And also, I'm going to be teaching you how to become your own banker and be less dependent on commercial banks and more independent, with just yourself and your family, and less dependent on others. So that's kind of going to be our goal for the conversation today. Before I get started on that, though, I wanted to introduce you to myself and my wife, Jen. Generally, we would do these presentations together, but since I'm doing it online today, I'm just going to do this by myself. But basically, my background is in property management. I've got about 20 plus years of property management experience. We came across the infinite banking concept a few years ago now. When we found out about it through a mastermind group, we were both very excited immediately. And I got online, looked up the Nelson Nash Institute, figured out the closest practitioner that I could find to my house. And I think that guy was in my living room a couple days later, and I was signing up for my first whole life insurance policy to be used for the infinite banking concept. So I've been basically all in on this idea since I originally heard about it with my wife, Jen. And then about a year and a half after I started personally doing infinite banking for our family, I decided to also move into doing it as a career so that I could teach others all the benefits of infinite banking as well. Jen's journey is a little bit different. Her background is in health and wellness. But together, we both think that, your health is your wealth and your wealth is your health. So you need to have wealth in order to buy things and do things in order to make your body and brain and mind healthier. And then also, the healthier you are, the more things you're able to do to create more wealth as well. So we do a really good job of playing off of each other and working together when we give these presentations in general when Jen's with me. So I just wanted to take a second to introduce both of us to you guys. I'm also going to take my face off the screen now so you don't have to concentrate on me talking. You can just listen and concentrate on the slides. So moving on here, at High Vibe Financial, we believe that the perfect life is having abundance in all five areas of life. And we identify these as spiritual, personal, family, financial, and occupational. Now, like I said, we think that abundance is in all five areas of these life. Sorry, abundance is having perfect balance in all five of these areas of your life. But today I'm basically going to talk to you guys mostly about just the financial area here. And we believe that, if you get this kind of figured out, then you can use your financial area to fund all of these other areas of your life, ultimately giving you abundance and kind of happiness in all of these areas. So as we go through this presentation today, I just want you guys to go into this with an open mind, and I want you to think to yourself, could it be possible that there are more efficient savings environments outside of commercial banks that you might not be aware of? So just keep an open mind as I go through this and think to yourself, is that a possibility? So as we teach people, like I was saying earlier, we talk about the financial area of life mostly. And one of the things that we use to talk about that with people is this wealth building pyramid. And the key components of the wealth building pyramid here, we've got two basic different areas of the pyramid. The first area is the base of the pyramid or the wealth foundation area. And this area down here, we start all the way down in the bottom with financial education, financial awareness, and a saving strategy, which we use the infinite banking concepts for that. And we're obviously going to be talking mostly about that today. But we also think people should have proper PNC insurance, debt strategy, other insurances. You should have a living trust, POA, and also asset protection. Basically, this entire bottom part of the pyramid is you're setting yourself up for a foundation that is going to be very hard to penetrate and something's not going to come in and then be able to derail you from what you're doing. So you just want to make sure you get this all set up first as your foundational area before you move to the top of the pyramid, which is the wealth acceleration area. Now, the top area up here, we believe in a cash flow management idea. We think profit first makes the most sense. And then there should be an investing strategy that you're doing as well. Now, on the bottom of the pyramid, when I was talking about wealth foundation, that should look pretty much similar for everyone. You should all be doing those exact same things, maybe in your own way, but you should still have all of them intact. Whereas on the top of the pyramid, the investing strategy, everybody should basically be doing something different. Jen and I think that flipping a home might be a great idea for investing. So we might go buy a home, flip it, put the money back into something else, keep flipping. Maybe you're more concentrating on laundromats, or maybe you like storage units, or maybe you like multifamily. Anything you're interested in, whatever you're comfortable investing in and what you have a lot of knowledge around is what you should be doing. And that's going to be different for everyone. But then again, getting up to the top of the pyramid is freedom is having that abundance in all five areas of your life. Now, we talk about all of this stuff, but what we're not talking about is that each of these areas here has something going on in the background, and that is the banking function going on in the background with every one of these items. And the banking function is basically what we're going to be talking about today and how to become your own banker. And what we talk about that from is the book Becoming Your Own Banker, written by R. Nelson Nash. So we're going to talk about this mostly today. And basically, in the beginning of the book, right in the introduction, he says, Becoming Your Own Banker, the Infinite Banking Concept is a text for a 10-hour course of instruction about the power of dividend paying whole life insurance. So, right there, we're talking about dividend paying whole life insurance today. Very exciting. Sarcasm intended. But just bear with me and keep an open mind, and we'll get to the point here. And if you're like me, you're going to think this is very fascinating. So, still on the first page here, this book is not about investments of any kind. It is about how one finances the things of life, which can certainly include investments, but it is not about a rate of return. So, we're not talking about rates of return today. So, in the book, Becoming Your Own Banker, he identifies a problem that we all face in our life. And that problem is that you finance everything in life. You either borrow money and pay interest, or you use your own money and give up interest that you could have earned elsewhere. And the problem is that all of these items are financed by other banking organizations. So let's switch gears a little bit here and let's talk about some common versus uncommon ideas. So when we talk about income levels, we're going to talk about income in the United States versus income worldwide. So usually I'll give a sort of an interactive thing here if I'm doing this a live presentation, but since I'm just talking to you on the computer here, I'm just going to kind of go through these. To be in the top US household income split point for the top 50% of income earning households in America, you would need to make $41,000 per year. To be in the top 25%, that's $83,000 per year. The top 10% is $145,000 per year. Top 5% is $208,000 per year. And the top 1% of income earning households in the United States, you would need to be making $515,000 in order to be the top 1% of income earning households in the US. Now, if you take that and you compare it to what it would require in order to be in the top 1% of income worldwide, that number is $34,000. So if you're making in the top 50% of income earners in the United States, you're making more than the 1%, top 1% of worldwide. So looking at this chart, basically, you can understand that income in America is not our problem. We all are making a lot of money. So if the income that we're making is not the problem, what is the problem? And we believe that that is the savings rate. We are not saving enough of the money that we are making. So how much should you be saving? So this chart here covers from 2000 to 2023, and the personal savings rate during that time was 4.7% on average. So Americans are saving about 4.7% of their income. You can see here in 2020 that bumped up quite a bit here, and then came back down and then bumped up again. This is roughly when we got our COVID stimulus checks. So some people put those into their savings account temporarily, and then they spent it, and then put a little more in when they got another one, and then spent it. But you can see even when we got that money, it all went away, and now we're right back to this 4.7%. So we're currently, as Americans, saving less than 5% of our income. So if you want to be common, just keep saving less than 5% of your income. We think that people should be uncommon and save uncommon amounts of money. So we think you should be saving between 10 and 30% of your money. So if cash is king, who has it? Now this chart takes you away from, I guess, the consumer and takes you over to businesses. This chart is about 600,000 small businesses that were surveyed and asked how many days of their median cash buffer days, how many days of cash basically do they have, where if you stop taking income tomorrow, how many days could you last before you had to shut your doors and you were out of money? Now, this chart right here is very important, especially for my wife, Jen, because we're just outside of Milwaukee. We're in Madison, Wisconsin. So in Milwaukee, people had about 25 days of liquidity in their businesses. So, go back to COVID times when you're wondering why a lot of businesses went out of business during COVID. This is saying that if a business had to shut their door for 25 days in Milwaukee, they were likely to have to go out of business. So my wife owned a sauna studio at this time, and she had a lot more than 25 days, but I think she made it between 3 and 6 months before she ended up closing her physical doors of her business. But this kind of hits home for her. And as you can see out here in California area, 26, 27, 28 days. This is why a lot of restaurants across the country went out of business too, because if you stop making money and your restaurant is closed, you can only last a month before you're out of money. So that's why we saw a lot of businesses going down during that time, which is why we think people should be saving more and having more access to cash for unforeseen times. So now switching gears to something that you might be a little bit more familiar with. Most of you have probably heard of Robert Kiyosaki, the book Rich Dad Poor Dad. He has another one that some people are less familiar with called the Cash Flow Quadrant. In this book, the main premise is that there are basically four different areas that a person could fall into in the US as far as a worker goes. In this quadrant, you have an employee, which means you have a job, a self-employed person that says you own a job, a business owner, which means you own a system and have people working for you, or you're possibly an investor where you own investments and then you have money working for you. Now, in this book, he's telling everyone the idea is to get from the left side of the quadrant over to the right side of the quadrant. So eventually you might want to be a business owner or an investor. But what he doesn't talk about is that regardless of where you are, whether you're a W 2 employee, a business owner, self employed, or investor, any of these people, similar to our wealth building pyramid in the beginning, every one of these people needs a banker in their life. So why not be an employee and a banker? Why not be a business owner and a banker, self-employed and a banker, or an investor and your own banker? Because an employee needs a bank to put their paycheck into. A business owner needs a place to keep their money. Self-employed people need a bank to put things in and out of. Investors need banks to put their investments in and out of. So everybody needs a banker in their life. So why not be your own banker rather than having a bank do that for you? Now, if you choose that you do want a bank to do it for you, there are plenty of people out there that are willing to do that for you. And some of those banks are on this chart right here. Bank of America, Wells Fargo, Chase, and Citibank are four of the biggest ones. Now, this chart, what it's describing is the amount of money that these banks are saving inside bank-owned life insurance or BOLI. So on the you and me level, that would be the same as a whole life insurance policy on a person. So they call this bank-owned life insurance or BOLI, and they've got 24 billion, 19 billion, 12 billion, and $5 billion saved up inside their life insurance policies that they have on basically their main executives at their banks, and they're saving this cash value inside these policies for a rainy day fund, basically. So whenever they need to go do something with money, they have easy access to cash inside these policies. So on one hand, they're over here telling us to take every one of our paychecks and deposit it into the bank, but that's not what they're doing. They're taking their extra cash reserves and they're putting them into life insurance policies. So it's a situation where you think to yourself, should I do what a bank tells me to do, or should I do what a bank is doing? I'm more of the follow what they're doing more than what they're saying kind of guy, which is why I really found this to be very interesting the first time I heard about it. But if you don't want to do this on your own, these banks would be happy to take your money and take care of it for you. But we'll see here in a second why banks find that this is a great place for them to be keeping their cash reserves based on how they think of things versus how maybe a consumer might think differently. So going back to the common versus uncommon thinking, when we think about whole life insurance on the common levels, on the you and me level even, we might have been told at some point in our life that whole life insurance has a low rate of return, or it's expensive to own, or it's the worst investment of all time. At some point in my childhood, somebody told me, don't buy whole life insurance. It's a waste of money. You should buy term and invest the difference. And that person was not Dave Ramsey. It was somebody else in my family, although I know Dave talks about that a lot. Um, But at some point, somebody might have said that, and I just took it as, the gospel because it was somebody older than me, and I never looked into it again until recently. But what we need to understand is that whole life insurance is not an investment. Nelson says it on the first page of his book. I'm just reiterating that again now for you guys. Then if you go down here at the bottom, Theodore Roosevelt, we knew this back in 1901 or 1909 when he was the president. Life insurance increases the stability of the business world, raises its moral tone, and puts a premium upon those habits of thrift and savings, which are so essential to the welfare of the people as a body. So, 120 years ago, they knew that life insurance was a great place to store savings and keep your money, and it was good for everyone. Somewhere along the line, we've gotten away from that. You can decide on your own, I guess, when that happened, but central banking system, stock market, that kind of thing, all, kind of took into play why people maybe think differently about life insurance today. But back in the day, they knew what they were getting when they were putting their money into this life insurance. Now, going from the common thinking of where you and I might be thinking now to the uncommon thinking of how a banker would be thinking of this, the banks know that when they put their money inside these whole life insurance policies, they get 8 main benefits inside their policy. And these 8 benefits are guarantees, constant compounding, liquidity, a flexible loan provision, privacy, passive income stream, income tax free transfer of wealth, and a high savings yield. I'm just going to touch on each one of these here quickly for us. So the first one is guarantees. Again, we're buying a whole life insurance policy, so obviously it has a guaranteed death benefit. Everyone so far has died, so at some point these policies will absolutely pay out and the death benefit will be paid. You also have a guarantee that your cash value is going to increase every day, every month, every year, so that's always going up. And also that you have leveled premiums, meaning your premiums are always going to be the same. They're never going to go up. So you're going to be paying the same amount each year. Next is the constant compounding. This is one of my favorite things to talk about with people because I love drawing this on a napkin if I'm in a bar or a restaurant and somebody wants to know what I'm doing and kind of get the just low down real quick. I can just draw this on a napkin for them. But basically, when I was a child, a lot of people would just go finance a car. So if you're going to go, you have no money, you're right here at zero, you have no money, I want to go buy a car. So you'll go to your car dealership and you'll finance the car. You'll go into debt this far with them, and then you'll just pay it back, over 5 years until you get back down to zero. At that point, you might buy another car and then pay it back until you get back down to zero. So this just kind of keeps repeating itself all the way along. Now, when I was a child, I think similar to Jen, my wife, we were both taught saving is better. You should pay for things in cash. You don't want to finance things. So save your money up and then pay for it in cash. Okay, great. So here I am up here. I can't buy that car in the beginning because I don't have any money. So I have to save up for the first 5 years or however long I'm going to save till I get enough money I can buy my car. Then I buy the car and I drain that amount of money back down to zero. Well, now I'm driving this car, but I need to keep saving new payments back to myself, probably into my savings account, so that 5 years from now, when I want to go get my next car, I just drain my account again and I go back down to zero. And I just keep repeating this. Well, once I saw this chart, what I realized is there is no difference. It doesn't matter if I'm financing and paying back or if I'm saving up and buying. Either way, I always go back down to zero. So then I thought to myself, oh, great, that's no better. So what is better is becoming a wealth creator through your whole life insurance policy. So here we're saving money inside our policy. We're saving up, saving up, saving up, building up our cash value. When we get enough cash value into our policy, we borrow against that cash value, drain it down here, and then we slowly pay it back. And as we're paying the money back to the insurance company, that we've borrowed against our money. So our money is still inside our policy, still collecting interest, still collecting dividends, but we've taken a loan against our cash value from the insurance company. So we're going to pay back the insurance company with a little bit of interest. But as we're paying them back, our money is constantly growing in here. So every time we take a loan, we pay it back, we end up a little bit higher than we were last time. So now I take a new loan out, I pay them back with some interest and I pay back the loan. And then when I get done, I'm back here because again, my money is still in here constantly growing and compounding every year. And this just continues to go up and up and up and up and up. So you never go back to zero. The next is the liquidity piece. And this is what we touched on in the beginning with the wealth pyramid. where there are the two different parts, the foundation and the acceleration, or protection and opportunity. So this is kind of a twofold slide here. Basically, the liquidity allows you to protect yourself in case something happens unforeseen. Your engine blows out in your car, you need a new refrigerator, HVAC system goes down, whatever. You would have liquidity in your policy in the form of cash value. You can borrow against that cash value and go buy whatever you need to get yourself out of a situation that you didn't see coming. On the opposite side of that, you can be saving cash value in your policy and you can be waiting for opportunities that show up. So, in 2008, when the housing market kind of crashed, that whole thing happened. A lot of people lost their behinds, but a lot of people that had access to cash made a fortune. And we're not suggesting that you should take advantage of situations, but if you have cash and there are people that need to get out of whatever situation they're in, you can help them out and you help yourself by getting some good deals on things as long as you've got access to cash in times where it's necessary. So it gives you both protection and opportunity at the same time. The next is the flexible loan provision. And this basically gives you a guaranteed line of credit. It's an unstructured loan and you have ultimate control. So again, within the whole life insurance policy, most people know that you can borrow against the cash value inside your policy. When you borrow against that cash value, your cash value stays in the policy. Your cash is continually getting interest as well as dividends. But when you take a loan, the insurance company will take a loan out against the value of your cash value, and they will charge you an interest rate. 5% ish is pretty common. So they'll charge you 5% to borrow money out of their general fund against the money you have in yours. And then you'll pay them back with that 5% interest. But the only thing you really should pay them is the interest, that you have to pay them at least. They're going to take that out right away. And then you have the opportunity as an unstructured loan to pay this back to them however you want, whenever you want. And quite frankly, if you don't want to, you don't have to, because they know it's a guaranteed loan and a guaranteed payment back. Because if you choose to never pay back the loan, at the end of the day, when you pass away, which is going to happen so far to everyone, they'll just take whatever loan you have out, deduct it from the death benefit, and then pay your beneficiaries the rest. So they know they're getting their money back one way or the other. In my mind, the only thing that you should pay every year is at least the interest. Otherwise, that interest will compound. But this is basically, in my opinion, one of the best things about these policies and the infinite banking concept, because it's an unstructured loan. So they don't set up a payment plan that you have to pay every month. If something happens one month, you can just skip that payment if you want to. You're in complete control of how you set this up and how you do it, which feels great versus basically having to rely on what a bank tells you you can or can't do. Next is the privacy, and we purposely don't put anything on this slide, which we think is funny, but basically these policies are so private that no one needs to know about them. You don't need to share it with your accountants. You don't need to share it with the IRS. Nobody needs to know. So even in, I guess if you want to compare it to a 529 plan for college, if you keep your money in this and it's got cash value, no one would ever know that if you were trying to go get a loan, or get some assistance for paying for college tuition. Whereas if you were keeping money into a 529 plan, they would be able to look that up and see how much money you have. So one more reason that I think this is better than a 529 for kids' college stuff, but also you can use this for anything. So if your child decides not to go to college, or you have multiple children that decide not to go to college, you can still use this for whatever else you would like to. Next is the passive income stream. So basically, it's an improvement to your income statement, even though you don't have to show it to anyone. You don't have to include it in your income statement. It's an improvement every month, and that's because of that guaranteed cash value growth every month that I also already covered. The next is the income tax-free transfer of wealth. Now on this one, and basically we're just talking about the death benefit. So whole life insurance policy, when you pass away, you're going to get a death benefit. That death benefit will go to your beneficiaries. So the insurance industry death benefits have about 28 trillion in death benefits they're planning on paying out, whereas the national debt right now is 36 trillion. So do I think the insurance companies are doing a better job than the government in managing money? Yes. The government so far, has put us in $36 trillion in debt. And there are a lot of people that think that the government's going to get them out of whatever situation they're in when they retire. And I just don't see that happening. And if so, I'm not sure how, because right now we're in 36 trillion in debt, whereas the life insurance companies have 28 trillion that they're planning on paying out, and they know how they're going to pay it. So again, going back to Theodore Roosevelt, life insurance increases the stability of the business world, raises its moral tone, and puts a premium upon the habits of thrift and savings, which are so essential to the welfare of the people of the body. I think we're doing a lot more for the welfare by, having money set aside that we're giving to future generations, to make our future generations and our families wealthier, versus what's happening with the government now, putting us into a little bit further debt every year. So I just think this does a lot better job of raising that moral tone. And then lastly is the high savings yield. So again, we're not doing this for any sort of an interest rate. That's not the point of this whole thing. Like I said in the beginning, this is not about a rate of return. But that said, it does have a decent rate of return, way better than just a regular savings account where you're making 0.01 or whatever they would give you, depending on, obviously the current economic climate, I suppose. But you do get a pretty good savings yield as well. So going back just to reiterate, those 8 benefits are guarantees, constant compounding, liquidity, flexible loan provision, privacy, passive income stream, income tax-free transfer of wealth, and a high savings yield. Oops. Not sure. 1 second. All right. So now let's just talk about investing versus banking, the differences here. And we think investing is intentionally separating your control of money with the expectation that additional money returns in the future. So this would be, you take $50,000 and you're going to put it as a down payment on a property that you're going to buy. You have to take that $50,000 and you give it to someone else. It's out of your control. You do that because you have an expectation that in the future that's going to create rent money that's going to come back and give you additional payments or income in the future. So you're expecting that money to come back in the future, but temporarily you have to separate yourself from it. Now, banking is the opposite. It's intentionally keeping your flow of money permanently in an environment where you have complete control and accessibility. So we're not suggesting that you should be an investor or a banker. What we're suggesting is that you should do both. So, instead of one or the other, why not be a banker and then use some of that money and go invest in real estate, or have your W-2 job and then go do something else with that money? You don't have to just be uh, a W-2 employee. You can do both. So it's not one or the other. Now, I just want to talk to you about my Uno Green 7 example, which I'm really excited to share with you. So basically, this example is the equivalent of you needing a $40,000 loan. So say you're going to be building a deck on your house and you need to get a loan to build that deck for $40,000. So in your hand, you have a red 7, which could be a friend or a family loan, a green 4, a bank loan, or a wild card, which could be basically the cash value in your whole life insurance policy. So those of you that know how to play Uno, you understand that you can play a 7 on a 7, or you can play the like color on a like color. You can obviously play a wild card on anything. So say you have a $40,000 loan that you need. If you have a friend or a family member that wants to give you $40,000 at a good rate, you might take that loan up. That could be your red 7. You might have a green 4 in your hand. That could be a bank loan. A bank might offer you a loan for this project. If they give you a good rate, you might want to take that option up. But if neither of those two options is available, you have a wild card in your pocket in this scenario, which is the cash value inside your whole life insurance policy. Now, that cash value or wild card is always going to be there for you. So you can use, as long as you have cash value inside your policy, you can use it to buy this, deck that you're building for $40,000. And it's always going to be there for you. They're never going to tell you no as long as you have enough money. Whereas a friend or a family member might back out last minute for some unforeseen reason, or a bank might back out as well. I had a coworker, colleague of mine that was planning on using his HELOC from his house to pay for a deck, actually. And I think the plan was like next Tuesday or something, they were going to start building it. And he got a letter in the mail that Friday prior that said that they pulled his HELOC, and they pulled everyone's HELOC because it was just unforeseen times. And so they couldn't have that much risk out there. So the money he was planning on using to build the deck 2 days later got taken away from him. Whereas, if he had money in a cash value life insurance policy and that was how he was planning on doing it, that would have never happened to him. So the great thing about the wild card scenario in this situation of the whole life insurance policy is not only do you always have it ready to go, but then when you start paying yourself back, you're going to continually have it. So it's kind of like walking around with a wild card in your back pocket at all times. So what card would you play? I would play the wild card. So now let's just talk about some frequently asked questions here. The first one that I usually get from people is, what if I am uninsurable? And the answer to that is, it's possible you are uninsurable. If that is the case, though, basically what we're trying to do here is we're trying to build cash value and then use it for things in life. So you could get an insurance policy if you can't get one on yourself because of uninsurability. You could get one on anyone else that you have insurable interest on. That could be a parent, child, spouse, business partner, some other options too, depending on the situation. But just because you might not be insurable doesn't mean you can't do this with someone else. The next question is, where do I find the money to start a policy? For this one, I'm going to go to the next slide here and show you some places that people keep money. So you keep money in vehicles, houses, travel, medical things, groceries, shopping, stock market, taxes. So these are some of the places that people spend their money. Um, so if you're trying to find a place, where you could start doing one of these policies where you're already spending money, I've got two good examples here. My wife and I started a life insurance policy just to pay our taxes. So basically, we pay premiums into our policy every year. And then at the end of the year, when we have to pay our taxes, we take a loan out against our policy, go pay our taxes, and then we just start slowly paying it back throughout the year to refill it. So then the next year we can pay it again. So over a course of a period of time, that's going to work out really well for us. The dividends are going to start really escalating, and then it's basically going to be able to pay our taxes for us down the road. Another nice example is with travel. A friend and colleague of mine, he was going to go on a vacation with his family. So he has a whole life insurance policy, but he also has a credit card. So they went on a trip and he put, I think, $8,000 or $10,000 worth of the travel and hotels and everything onto a credit card. He got the free points or the 2% cash back or whatever. And then when he came home, he just took a loan out against his life insurance policy, paid off his entire credit card bill, and then just paid himself back to his policy at his own pace. So he was able to capture that 2% or whatever he got from the credit card company, but then he still got all the control back right away, which was great for him. So let me just go back here to the other questions. So, am I too old to get started? The answer to that is no, because again, even if you personally were too old, you can always do this on someone else if you need to. But I think anybody up until about the age of 85 could get a whole life insurance policy, but it might not make sense to do it on a person for infinite banking purposes, if they're over 70, 75, just depending on the situation, health, that kind of stuff. So, but I would say no one is too old because you can always do it on someone else. Can I put a lump sum of money into the policy? Yes. So the insurance company that I write with generally, each life insurance policy has basically two pieces to it: the base piece that buys mostly the death benefit, and then we also have an additional piece, rider on it that we put on that's called PUA, which stands for paid up additional cash or paid up additional insurance. So basically, we allow people to put up to 3 times the amount of the base, which is by the death benefit, into the cash side. But the first year, you can put up to 10 times the amount of cash into the paid up side that you can on the base side. So, if you wanted to pay $10,000 a year for base premium, you could put a lump sum of $100,000 in the first year, just to give yourself a big fund kind of to be borrowing against, just to make a little more sense to people up front. A lot of people that have the money laying around, they like to dump a little bit more into it in the beginning. What if I can't pay the annual premium? When I design these policies, I purposely set them up for flexibility in both directions. So again, the one piece is the base piece buying the death benefit. The other piece is the PUA, which is the additional insurance. So I make it flexible so that if you can't pay all of it that you're planning on for some reason, your minimum is going to be about half of what you have to pay. So I'm already making it flexible for people. But then again, if there's worse things that happen than that, depending on how long you've had the policy, there are plenty of ways around, how to pay the annual premium. Sometimes people have taken a policy loan to pay their premium if they're in an absolute pinch. You can also just pay the base part if that's all you can pay that year. So there are plenty of ways around it, but we do set them up with flexibility right off the bat on purpose, just because, life is, I guess, not um, certain all of the time. Why haven't I heard of this? Well, I guess my initial reaction to that is no one has any incentive to tell us about it. A banker is not going to tell us about it because then we might do this instead of using his bank. I think a lot of our parents and other adults that maybe would have taught me didn't understand it or didn't know about it. So I think that's the main reason. But yeah, anybody that is doing it, they don't have a lot of incentive to tell anybody else about it unless they're just a good person. And that's one of the main reasons I got into this is because I think it's so valuable for me and my wife. I wanted to be able to tell other people about it as well. So I'm happy to talk about this with whoever wants to listen as much as they want. How much money premium should I start with? I think that's just a comfortable number for you. Whenever I talk to people, the first time I always have an hour conversation with them, kind of figure out where they're at, talk about ideas, strategies, what their goals are. We come up with a number that probably is going to work out for them. But my thought on this is you should always do something that is comfortable, but maybe stretching yourself a little bit, just because we do have flexibility up and down. But we want to make it at least make sense for you by getting enough in there that you're going to see the value to it. So going back past that one. All right. So human life value, a lot of people wonder how much insurance they can get. So one of the ways that the insurance company decides on this is a human life value, which is basically just the amount of times your income based on your age. So if you're under 40, the max you could get would be 30 times your income. So if you had an annual income of $100,000, you could get 3 million in death benefit. If you're between 41 and 50, you can get 20 times your income and so forth. So just the older you get, the less you can get, obviously. But if you're too old in your mind, like I said, you could also insure somebody younger if you wanted to, but it just depends on the situation, which is why I always tell people to reach out, have a conversation with me, and we can figure out what works best for you. Correctly structured whole life insurance policy. So I stole this chart from my colleague, but I love it. We used $100,000 premium here. If that makes you nervous, divide it by 10 and call it $10,000 per year. It doesn't matter. The math is the same. So in this scenario, this 46-year-old person puts $100,000 in premium in per year. And we've designed this where 25% of it's buying the base death benefit and 75% is going towards the cash side. So the first year, you're going to have access to about $74,000 in cash that you could borrow against the first year. As you can see here, if we go down to year 4, that's basically when you're breaking even, meaning the premium you're putting in is creating that much cash. So you haven't gotten where you totally broke even yet, but at year 4, you put $100,000 in, you've got $104,000 more in cash value. So at this point, you're putting more in, your cash value is creating more than your premium. Now, if we bump down to year 8, at this point, you've put in 800,000 and your policy is now worth 818 in net cash value. So going forward from this year on, you're even 18 grand above, and then from there on out, every year it just escalates faster and faster and faster. And at the same time that your cash value is growing, your death benefit is also growing. So, and again, these things are guaranteed to go up every year. So it's like you're signing yourself up for a business that is guaranteed to succeed, and it's guaranteed to have more money every year than it did the year before. So knowing that, how much money would you want to be putting in is the question I always ask people. So why only dividend paying whole life insurance when there are all these other permanent insurance options out there? And again, dividend paying whole life is the only one that we recommend. This is the one that Nelson Nash recommends in his book, Becoming Your Own Banker. And it's just because of the guarantees. Everything is guaranteed in the whole life insurance policies, whereas These other ones, universal life, variable life, indexed universal, adjustable premium, stock owned whole life, these have a lot of fluctuating costs, charges, fees. You can change up and down a lot of things in all of these policies, which just make them all a lot less of a guarantee. And what we're doing this for is the guarantees, the death benefit, and just knowing that our money is going to be where it's going to be. So if people want to take some money and go play in the stock market, great. But that's not where you should be keeping your money inside a policy that has anything to do with the stock market, in our opinion. That's why we recommend only dividend paying whole life insurance, just like Nelson does in his book. So then we say this is a story worth saving. It's about saving what you work so hard to build. It's not about leaving your children rich and spoiled. It's about teaching our children financial fitness. A great example here is we've got a couple of good friends who have three daughters. The parents are both retired military. Their three daughters, they've gotten whole life insurance policies on the daughters. They're teaching their daughters how this process works. The husband and wife have a policy on them. So when the daughters want to come to the parents and say, hey, I'm going to go buy my first car, I need a car, they're going to borrow money from the parents' policies, and then they're going to pay the parents' policies back. They're not going to go to a bank and get an 8% loan for a car and then pay the bank the interest and have the bank make the money on the loan. They're going to take a loan from their parents, and then they're going to pay their parents back with interest, because they know at the end of the day, when their parents pass away, they're going to get that money back. They're going to get the death benefit. They're going to get whatever's there. So why not teach your family how to do this and keep it going for the rest of your lives versus giving all the money away from your family into a bank? I think people do this pretty well and pretty often. If you've ever been to like a professional sporting event, they've always got people there trying to get you to sign up for credit cards, to anyone over 18. And they're trying to basically kind of drive a wedge between children and their parents when it comes to money, and kind of have people depend more on banks and credit card companies. So this is just a really good way to teach your children, make it a family commitment, make it a family bank. And then this is something that can just be passed on generationally, which is what we're trying to do, for ourselves and for our friends. All right. So when the student is ready, the teacher will appear. How do you get started? So again, like I said, my name is Mark. I'm with High Vibe Financial. Thank you so much for joining me today. If you do want to contact me or have questions, you can reach out to me at mark@highvibefinancial.com right here. Otherwise, if you were to click on the box on the left, book a call with me, that'll take you to my Calendly link, and you can schedule an hour call with me to chat about whatever you'd like with Infinite Banking. And then the more information on the right there is a link to my website. And on our High Vibe Financial website, we've got blog posts, we've got more information, other good things that you can just read about this. If you have questions, you can contact me on there as well. So all of these options are a great way to get a hold of me. I hope that you got a lot out of this presentation today. And if you have any questions, I hope that you please reach out to me. Thanks a lot, and have a great day.